there's a very famous quote by Warren Buffett, right? So he basically says that be fearful when others are greedy and greedy when others are fearful. What are your thoughts on buying versus renting?
I'd say at least for when you're young, right, below, let's say 30, it doesn't make a lot of sense to buy.
Making your selling decision just because your money has doubled might not be the best
Yeah.
approach.
Just understanding the fundamentals of why the stock market even exists, why do companies list on the stock market, what does it mean to own a stock. The best way to learn is by putting capital in.
Hi everyone, thank you so much for joining us today. Welcome to Cashvisory's podcast. I'm Utkarsh, the co-founder, and we are trying to solve personal finance for millions of Indians. Our objective is to get every single young working professional to their first investment. We have a very special guest here today on our second podcast. We have Rohan here, who's a BITS Pilani alumnus. He's someone who is an engineer, but he found his way to finance. So he actually did an investment banking as well as equity research internships with JP Morgan and Ernst & Young. And he's currently the product head at Bluelearn. So welcome, Rohan. Looking forward to chatting with you today about money and so many other things.
Likewise, Utkarsh, great to be here.
Your profile is really, really impressive. First of all, you were in BITS Goa and you had academics to manage. You did a couple of internships. You're the president of a investing club. By the way, I would love to know how that happened. So first of all, tell me a bit more about your college journey and how did things flow there?
Yeah, so got into BITS Goa for electronics and instrumentation, 2018 that was. And college was wild, especially because it was in Goa. A lot of excitement to even go there, first of all. And in college, so BITS has a lot of clubs. So at least 20, 30 clubs where in first year you're almost spoiled for choices. But thankfully, before I joined, I knew the 2 to 3 things I really wanted to focus on. So my journey with finance actually started in 12th grade when, like, funny story, I had an injury. So I hurt my leg while playing cricket. So I couldn't travel to my IIT JEE coaching by myself. So I had to travel with my dad. And during that time, my dad always listens to ET Now, the news channel, when he's driving.
Nice.
So he's driving on background, it just runs. So because I was in the same car, like I got exposed to all these jargons, like what are stocks, why do stock prices fluctuate every second? So, and whenever I used to come across something I didn't know, I just asked my dad. So that was
Right.
my first foot in the door into finance, I'd say. That's where the spark was ignited, and that's where I learned the basics. And following up on that, in 12th, whenever I used to get free time, which was very limited, but whenever I did, couple of YouTube channels, I think Khan Academy, I watched a lot for basic economics, not even finance, like
Right.
what are assets, what are liabilities, um, housing, all of that. So I learned the basics of that. So when I got into college, I knew I had an inclination towards finance. So Wall Street Club, which is the finance and investment club of BITS Goa, was the first club I even interviewed for, and luckily got through. And since then, that was the start of like everything I did in the next 3-4 years. So yeah, participated a lot through the activities. So a couple of good things Wall Street had was a lecture series. So the seniors, second, third year students would take a lecture series for the first yearites,
Interesting.
encompassing everything from fundamental investing, technicals, options, financial crisis, all of that.
Right.
So learned all the basics in my first year through that. And alongside did a bunch of online courses on Coursera, a lot of YouTube videos.
Right.
So learned the basics in first year. Then second year onwards is when I started investing myself. We'll probably get to that as well.
Yep. Would love to hear your journey there as well. And
For sure. Yeah.
when you were talking about how you got started with learning about money, right, which was from overhearing the ET Now piece playing in the background and then
Yeah.
researching more into it, that gave me a bit of deja vu because when I was I'm an engineering graduate as well, right? And for the
Yeah.
first 3 years of my career, I had no idea about money at all. So I used to just play Bloomberg in the background.
Wow.
Right?
Yeah.
So very similar journeys, and this is amazing.
Yeah.
So tell me about investing, and you were just segueing into how you got started in second year.
Yeah.
Now, of course, as a college student, you don't have too many sources of income.
Correct.
So what was your first pool of money that you actually started investing with?
Got it. Again, funny story. So at BITS, we have this scholarship called merit scholarship, where if you're in the top, I think 1 to 5% of the batch, you get about 40% of your fee back
Oh,
in
wow.
your account. So I was in the top 5%. So what happened is my dad paid the fees and the college would refund it to my account because I was in the top five. So that was my first capital. Technically not mine, but still, that was what I
I mean,
initially.
well earned, definitely, I would say.
Yeah, so that was what I started playing around with. So that was my first pool. So I think it started in second year when I started receiving this. So that's when I started, deploying it, playing around. So my first initial capital that I got, I just wanted to test out what stocks do what.
Right.
So everything from like the smallest of small caps to like the mega caps, I invested in all of those,
Right.
saw how they perform over a couple of months, learned the fundamentals through that, and then moved on to like actually serious investing.
Got it. No, this sounds really amazing, and the kind of approach that you took, which is testing the waters, right?
Yeah.
I call it jumping into, like, dipping your toes into the swimming pool, basically,
Yeah.
right, before you start investing.
Yeah.
So I'm glad you did that. I think to all the young listeners who are listening to us, if you want to really get started, that might be a really great approach. We'll dive deeper into this later, but amazing to hear this, and super impressive. So tell me a bit more about your sort of principles of investing, because you mentioned that you got started, you started building that intuition,
Yeah.
where you started understanding how you should be deploying the money, what stocks should you be picking. So
Yeah.
first of all, before we even get into that, what does your portfolio currently look like? Is it
Okay.
a combination of just direct stocks? Is it mutual funds? What are the other asset classes that you've gone into over the years?
Got it. So right now, majority of my portfolio is in equity.
Mm-hmm.
So about 90% is in equity and 10% I have small debt allocation,
Right.
which is again for extreme events. Like if in case the market crashes tomorrow,
Right.
I liquidate the debt and put it into equity again.
Makes sense.
So there are times when my portfolio has less than 5% debt,
Mm-hmm.
but then I then refuel it to 10. But within equity, it's equal split between direct and mutual funds.
Right.
So 50% in mutual funds, 50% in direct, and even within mutual funds, equally divided among small, mid, and large caps.
Right.
But in my direct portfolio, more weightage towards small and mid.
Right.
It's been that way since 2019 when I started.
Right.
Felt that there's more growth opportunities in that segment. So naturally had a lot of allocation there.
Right.
So if I had to put a number, I'd say about 70% is in small and mid and 30% is in large
As in
cap.
large caps.
in
No,
my
that's
direct.
really interesting, and a lot of key takeaways, I think, here for our audience to take. I think the first most important one is the principle of diversification, right? So
Yeah.
you've kind of not put your eggs into one basket. You've diversified among asset classes between stocks and mutual funds and even debt.
Yeah.
You talked about a very, very important piece of holding some amount of money as your emergency stash,
Yeah.
which you can also use for something which we call smart dollar cost averaging, right? So SIPs obviously help you dollar cost average, but then when markets take a larger hit, you do have some capital sitting there
Yeah.
to take advantage of those situations.
Exactly,
So that's
yeah.
amazing to hear,
Yeah.
and kudos on the approach that you've been taking so far.
Thank you.
So would you say, I mean, with a large amount of equity split, would you say you're someone who's an adventurous investor, someone whose focus right now is to grow their wealth?
100%. Like I feel because like of my age and where I'm at right now, I feel I have that leeway to take a lot more higher risk than someone else could.
Absolutely.
So I feel adventurous would be the right word to use.
Okay, so let's go a bit deeper into your sort of investment principles,
Yeah.
right? So when you, let's say, go into deciding which stock to invest in, like, do you have a set process that you follow currently? Like, do you discover the stocks yourself? Do you work with someone? And once you do discover a stock, how do you end up analyzing it as an investment opportunity, like a yes or a no?
Got it. So it starts off top down. So I basically first filter out the industries which I'm myself bullish on,
Right.
or which I feel have a 30, 40-year horizon visibility.
Mm-hmm.
So that's my first layer of filtering.
Right.
Now, once I have these industries sorted, so within the industry, I mostly look for 3 to 4 metrics, starting off with the PE ratio. That has been my go-to since the time I started.
Right.
So mostly value focused.
Right.
And for companies which have a PE ratio on the slightly lower side, I look at sales and profit growth over the last 3, 5, and 1 year horizons.
Got it.
So
Well, this is amazing, but just for the sake of our audiences, guys, PE ratio stands for price versus earnings, right? So it's a metric that is used very often in the industry to determine what the value of the company is. and obviously you have you can compare the metrics for a particular company, for the industry, or the broad market in general as well. So I think that
Yeah.
that's a great point. So I think Rohan tries to assess the valuation, whether the
Yeah.
company is fairly valued right now, which makes
Yeah.
complete sense. I think there's value investors, the likes of Warren Buffett, who
Yeah.
subscribe to the same principle. And you also
Mhm.
also talked about a very important thing, which is growth, right?
Yeah.
So how fast is that company growing, right?
Mhm.
Amazing. Please go on to what are the other things that you look at.
So mostly it's these three to four,
Hmm.
and obviously compare it to peers in the same industry
Right.
for benchmarking.
Hmm.
And once I find the top one or two,
Right.
then mostly the last layer of filtering comes when I do the qualitative part of it. I listen to the last 2-3 quarter analyst calls,
Yeah.
their annual AGM calls, all of that, just
Right.
to understand what kind of management, what their speech is like in terms of sentiment, what they
Right.
think about the company. So that's just the last layer of filtering. Very hard to decipher because a lot of them speak in a very similar way at
True
that
that.
point. But after that, I narrow it down to like one in the industry.
Hmm.
And finally, to figure out entry points, I use very little technical analysis.
Right.
Again, like I'm not a big fan of timing the market. Like
Hmm.
I feel just put it in. Anyway, my investment horizons are 10 years, I'd say. Like I don't
Right.
want to redeem within 10.
Hmm.
So entry point doesn't really make that much of a difference. But just to make sure I'm not investing at a very high point, I just look at a few technical indicators.
Right.
RSI, relative strength index is one,
Right.
and that's mostly it. After that, I just figure out whether it's now or should I wait a week or two, and
Got it.
then I invest.
Right. That's pretty amazing as well. So I think a couple of other things that Rohan has covered here are crucial. Like once you sort of fundamentally know how the business is doing, what the core financials of the business look like, then we sort of go into deciding the entry points. And I think
Yeah,
one thing that you said is really important, which is timing the market is not
yeah,
the most important thing, right? I think
yeah.
most people try to do that, and that's where they go wrong, which is
Mm,
just try to sort of decide their entry and exit points very carefully. As opposed to
yeah,
that, what they should be focused on is buy something and hold it for the longer
long
run,
time.
right?
Yeah,
If you look
for
at
sure.
most people that have made money in the long run, it's been those people.
Yeah,
Of course, unless of course you want a career in trading and you would like to do that, great.
yeah.
But agree with you that I think a 7 to 10 year time horizon for holding a particular
Mhm.
stock makes a lot of sense for
Yeah,
most retail investors. So this is the great point, and I think going into the second piece of this, now you've decided a particular stock to buy, you've decided
mhm.
certain mutual funds that you want to invest in based on macro, micro, as well as the other factors we talked about. Now, let's say when your stock is your portfolio is currently moving in the direction that you wanted to move in. So
Yeah,
do you do sort of regular management as well? Do you review your portfolio from time to time?
yeah.
And if there's something that you do there, how do you sort of take that forward?
Yeah, so I do review my portfolio
Hmm.
almost on a daily basis. I keep track of it on a daily
Right.
basis, but I don't make changes that often. But every month when I have cash inflow through salaries, I look at what existing stocks I can double down on. So, couple of things. One is how have they performed in the last 1 month or few months,
Right.
and whether I can again dollar cost average. If the stock has fallen down a bit and I'm still
Right.
very bullish on it,
Hmm.
I put more into that.
Got it. Got
So
it.
monthly, I do small adjustments like add. I don't remove, just decide which ones to add more
To add
into,
more into. Right.
and just keep that going monthly.
Got it. No, that makes a lot of sense. Where you sort of again, it's what we call smart SIP into
Yeah,
some of those
yeah,
stocks which you're bullish on in the long run. But I think there's one common sort of risk here that comes into play, right? Which
hmm,
is, let's say a particular stock is falling in value due to whatever factors,
yeah,
right? Sometimes what ends up happening is that stock ends up being a value trap. Like there's something
yeah,
that's really wrong at a core level, or the
yeah.
business might be failing, right?
True, true.
So how do you sort of make sure while doubling down on a particular stock that it's not a
Hmm.
value trap at that stage?
Yeah, good question. Very hard to figure out. But so one thing I use is I use Twitter a lot for very short-term sentiments.
Mm-hmm.
So if you just go to the search part of Twitter and you type the stock's name, you get
Yep.
the last 20, 30 tweets related to the company.
Mm-hmm.
And through that, you get some sort of sense whether it's a core issue, whether a lot of people are just saying, okay, it's fallen, just buy.
Right.
That is kind of a red flag because you can't have everyone just wanting to buy if it's falling.
Right.
So I use that a little bit,
Mm-hmm.
but apart from that, to figure out if it's a value trap, If it's happening after a recent quarterly call, again, listen to the recordings of the call. That I do for most of my portfolio companies
Right.
whenever the quarterly call happens. So that does give some indication. But apart from that, going through analyst reports, like I see recently, if any brokerage has upgraded, downgraded that particular stock,
Right.
if there has been a downgrade, then I stay away from adding more into that.
Correct.
So
Correct.
those, because they have a lot more information than I do, so I just trust their calls on that.
So that's a very good point that you made, and just to sort of add on to some of the important things that you mentioned, like we as sort of financial advisors, when we look at a stock and when we try to determine whether that stock is a value trap or not, we sort of try to look at changes and patterns within the company's operations or finances. Like one small
Understood.
example for you is, let's say if the company's sort of revenues are falling. Right. It could be that it falls in the short term due to a justifiable reason,
Yeah.
but if they're falling due to a systemic reason, right? If the customer base is falling, if there's an industry trend shift, maybe there's a disruptive technology that's come in because of which this business might not be as attractive moving forward. So I think those are factors which you could look into more in the future,
sure.
because those are more important things to. Because sometimes prices might drop just because of short-term sentiments, but sometimes it could really be because of a systemic
issue.
problem with the business.
100%.
Right.
Yeah.
So I think that's a good one for you to think about.
sure.
Also, like you did talk about analyst reports, right? So just wanting to deep dive into that a bit more,
Yeah.
because I think one thing that people find hard to differentiate between is what are the short-term signal versus what are the long-term signal,
Yeah.
right?
Yeah.
Because a lot of times when a stock is downgraded, upgraded, it's for a 6-month or 1 year time horizon. So how do you sort of look at it yourself being a long-term investor?
So yeah, analyst reports are purely used for, as I said, the monthly additions I do. So if in the short term someone's bullish on it, then it gives me a sense that okay, even if I put it in that long term, if it doesn't work out, at least I'm not going wrong in the short term.
Got it.
So it's more of a indicator in the short term, but long term calls again purely based on the things I mentioned: PE, sales growth, analyst calls. That's how I usually do it. But yeah, analyst reports don't use it too much, but just for these smaller.
No, that's
monthly
a very
things.
valid point. So basically, it's a bit of price discovery as well, right? And also determining. So again, we're not timing the market in the sense that we're not trying to decide whether or not to buy the stock. We just optimize our buying time, right? So I would say that's slightly different from timing the market. That's deciding your entry points smartly, as opposed to deciding whether to buy the stock at all or not, right? So I think this is a very interesting concept that a lot of other people could use as well.
Yeah.
And they,
give
please.
some sort of validation as well. If
Exactly.
for the stock you have shortlisted, if there are positive analyst reports,
True that.
some good validation and more confidence for you to put your own capital.
Makes sense. Makes complete sense. But one point I would like to highlight to those retail investors who would like to be invested for the long run, is that some of these news and short-term signals tend to be noise when you look at a 10-year time horizon. Right?
Yeah.
So that is something
100%.
that's a key takeaway from here. So I want to talk about this very interesting concept, right? Which is basically invest in sectors and companies which you consume yourself. Right. So is that
Yeah.
something that you use to decide stocks and sectors that you invest in yourself currently?
Yeah, 100%. I don't know if it's a bias or it actually works.
Right.
But yeah, and for me, at least in my context, I travel a lot. So good chunk of my portfolio is in hotels, flight, and the
Right.
tourism industry.
Correct.
So I think the advantage is because you use the product a lot, you understand granularities that probably others don't in
Right.
terms of when it comes to traveling, like at what type of people travel, because
Right.
you see those people when you are traveling. And when you know that the economy is moving in a certain way, a specific demographic is increasing in size, you
Right.
know the next step for them is to travel and spend on travel.
Right.
So understanding slightly, the demographic side, what kind of people use, specifications of the product, kind of give you a slight unfair advantage on those who don't consume the product or industry.
Makes sense.
So just making use of that extra knowledge you have and doubling down on that. That's how I look at it.
That's a very good point.
Yeah.
Yeah. So and what you just said, like I totally relate to that. So I do a bit of that with my personal portfolio as well. But just to give you an insight into how I use it. So let's say if there's a particular product that I'm using a lot, and I really like that product or that service, I vouch for it. I use that as my entry point into researching it further.
Yeah.
Like, for example, the travel
Nice.
piece, right? So if
Yeah.
I'm an avid traveler in India,
Mhm.
I would go in and look at what's happening in the general travel industry after my own interest. Like, what's just like a startup, right? What's the
Yeah.
total addressable market? How
Correct.
fast is this market growing, and what are the
Mm.
companies operating there? So the
Interesting.
travel sector specifically in India, like, it's projected to grow at almost 17% CAGR
Yeah.
for the
Yeah.
next almost 7 to 8 years. So that's a great one to be in,
Yeah.
and totally subscribe to that idea. But I think building up onto your own sort of experience with market research is, I think, the best approach, which I think
Yeah.
is something you're clearly doing. So kudos on that as well.
Thank you. And good point you mentioned. Because you are using a product, you are inherently more motivated to even start research on that.
True that.
So it pushes you to actually analyze, go through the depths of it,
Right.
and eventually, yeah, you can get a few detailed insights out of it and make better calls.
Makes complete sense.
Yeah.
Okay, so now let's get into your again investment journey that you've had over the years,
Mm.
right? Because I believe you started investing sometime around 2018, 2019.
Yeah.
So you've been investing for a good 4 to 5 years now.
Yeah.
So tell me, like, over the years, what are some of the key sort of things that you've learned about market trends, about
Mhm.
economic cycles, and
Yeah.
how do you sort of navigate those as a long-term investor?
Got it. I think for me, I wouldn't say lucky, but one thing that happened was when COVID happened, it was almost like a 10, 20-year market cycle condensed into 1 or 2 years. Like the fall that happened with COVID, the
Right.
recovery after that. And even before COVID happened, when I was starting out, there was a whole NBFC crisis that
Yeah.
happened. So getting to see all that in the 4 to 5 years, like I feel kind of exposed me to what could go wrong if
Right.
things go wrong. So just having that in the back of my mind kind of helps me make better decisions, I feel. And in terms of market cycles, couple of things I've learned or done in the last couple of years is when there are sharp market falls, it's more often than not a good opportunity to buy. That same thing happened in 2008 again with COVID,
Yep.
rather than being fearful and trying to exit your positions. So that's one thing I try to follow. If there's a sharp correction, let's say 10-15%,
Yep.
I use it as a buying opportunity. And that 10% of debt I mentioned earlier is for such situations, like so that I can liquidate and put it in whenever I can, instead of
Absolutely.
having to liquidate my equity and then wait for it to fall more and then put it back in.
Right.
Because you never know when the bottom's going to form. Like it could keep going down
Absolutely.
or it could
Absolutely.
just recover.
No, that's a
So-
very, very important point. Like, in fact, there's a very famous quote by Warren Buffett, right?
Mhm.
So he basically says that be fearful when others are greedy, and greedy when others are
Yeah,
fearful,
yeah,
right? So
for sure.
basically, look at opportunities when everyone else is sort of exiting the market, because that's when you'll
Mhm.
find better value deals.
Yeah,
Right. So
yeah.
I think that's a very, very important point. And another important point to something that you said is when you're looking at a market crash happening and then going in and using that as a buying opportunity, it's important to know that you are buying into a diversified portfolio. So
Yeah.
in a very bad economic climate, you might have one or two companies that might fail,
Mhm.
but 30 companies failing,
Yeah,
now that's not as likely.
absolutely. Yeah.
So I
Yeah.
think that for all the retail investors out there, that's an important point when you're trying to sort of look at good buying opportunities during those bad times. Make sure that your portfolio is diversified as opposed to just focusing on one or two stocks, which might be more uncertain, right?
For sure.
So
Yeah.
that is something just to add on to everything that you said here as well. Okay, so we've talked about a bit about how you decide your the stocks to invest in. We've talked a
Mhm.
bit about the regular management that you do over the years. Now, and I know that you're a long-term investor, so you probably haven't done too much of exiting your stocks.
Yeah.
But if
Yeah.
you were to, how would you go about deciding your exit points for your stock investments?
Got it. This is something, honestly speaking, I do struggle with, like figuring out when to exit.
Right.
But until now, I still do believe that holding it for at least 5, 7, 10 years will maximize my chance of making returns.
Right.
But when it comes to exit, till now I haven't done it. But if I were to do it, I think a good way would be to exit sequentially and not at once,
Mm-hmm.
so that you still have some exposure to make use of the upside if things go up even after you exit.
Right.
So that is something I probably will follow when I do exit. But yeah, to be honest, nothing much to share from my experience on
Got
that.
it. No, but this is great. The key point that you highlighted there was sort of don't be too extreme with what you do, right? There can be a middle path for you.
Yeah.
So I'll give you a small example of this. Like, imagine I have this friend who invested in the Nvidia stock, right? Before this entire sort of crazy euphoria started,
Yeah.
and his investment doubled just in a matter of a month or so.
Right.
So he came to me, and the first question he asked me is, should I exit the stock.
Mm-hmm.
When we looked at that stock, we saw that it's still undervalued. So making your selling decision just because your money has doubled might not be the best
Yeah,
approach. You got to
100%.
look at it as a new checkpoint, and what's the value of that stock at that new checkpoint.
Yeah.
Right? If it's again still undervalued, you could, even though it's doubled, you could still invest more.
Yeah.
And
for
if the
sure.
valuation has gone to the higher side, then you could start making some exit decisions as well. Right? That's where I think the key concern or the difficult thing happens when it's somewhere in between.
Correct.
You can't tell if it's overvalued or undervalued. In those cases, what I recommend doing is what we call trimming the hedges. Right? So you could sell off some parts of your investments to book your profits.
Yeah.
But at the same time, you could still keep some amount invested to back your winners.
Correct. Yeah.
Right? So this is something that you could look into when you
For
start
sure.
exiting your investments in the future.
Yeah. I think one more thing that comes into play is cyclicality of businesses.
Mhm.
So sometimes, like, I feel this has happened to me, like a slight bias of sorts. Like, whenever I do analyze my portfolio on a monthly or quarterly basis, and I recheck the fundamentals of all my companies,
Yep.
some of them do have bad quarters because of the nature of the business itself is cyclical.
Yep.
So sometimes that could give you an indication that, okay, the company is not going to do well anymore,
True that.
but it's just like a short-term blip that they face.
Absolutely. That's a very good point.
And for
And-
some industries like real estate, the cycles are not in quarters but in years.
Years.
Like 3-4 bad years and then 10 good years, or the other way around. So
Right.
knowing that it's a cycle itself, I think helps you take the call on should I exit now, or is it just a short-term cycle that I have to just wait for it to play out.
Right.
So just having that also in the back of the mind, I think.
No,
would
that
help.
makes complete sense. And another sector that again we were talking about Nvidia stock.
Yeah.
So semicon is again a sector that's highly cyclical. You'll see that company revenues shoot up when there's very high demand for certain kinds of chips.
Yeah,
And
yeah.
globally, then the market gets flooded with a lot of these chips. And then the opposite happens for
Right.
these cycles generally are range anywhere between 1 to 5 to 2 years.
Right.
But yeah, it's a very important point to, if you're doing sector based investing, it's very important to understand these macro trends within these individual industries and sectors, because
Yeah.
they inform your investment decision for sure. So that's
For
a very
sure.
valid point that you made. So you're someone who got interested with this entire topic and started when you were super young, right?
Yeah.
So even as someone who was doing engineering, doing a course which has nothing to do with it, you joined a club to gain your interest and knowledge. So you were driven about this, right?
Yeah.
But a lot of us aren't. Like for example, for me in college, I wasn't learning about money in college. I started
Right.
much later when I realized that, oh, what am I missing out on?
Yeah.
So what would you say for those people who just want to get started but don't have the amount of time to put in the kind of commitment that you did when you got
Right.
started?
So I think initially, before you even start putting your first rupee or dollar in, just understanding the fundamentals of why the stock market even exists, why do companies list on the stock market, what does it mean to own a stock, just these basics, if you can learn properly, I think that'll give you a good foundation to work towards after that. And post that, what I believe is the best way to learn is by putting capital in. So how I would go about it is, if you have, let's say, 100% of cash with you, put 90% into things that are safe. For example, a mutual fund or an
Right.
index fund. Just put it there, because the chances of that going wrong is very low.
True
Like
that.
you are trusting your money with someone else. But the remaining 10%, keep it as like a learning capital for you to play around with. Like invest in different sectors, different stocks, leave it for 2-3 months, see what happens.
Right.
And through that, I think you build a lot more confidence in investing, and also you learn how things move or what you need to look at, what things
Right.
do well. And once you start getting more confident about the decisions you're taking, gradually move the 90% more into the direct stock portfolio that you have.
Correct. No,
So-
that makes complete sense, Rohan. And in fact, one very, very important point that you mentioned here is that you need to have skin in the game, right?
Yeah.
To learn anything. So unless you like invest even like 100 rupees, right? You won't start following the stock market. You won't start seeing these economic
Yeah.
trends manifest.
Yeah.
And the most interesting thing to me was that right now there are mutual funds and ETFs in the country. You can start investing with 10 rupees. Right.
Yeah,
So
I know
imagine
that.
a college student
Yeah.
that's getting a small pocket money could also try that out to start learning.
Yeah.
Right. And I think that's the most important thing. In fact, I would say that for a lot of these retail investors or people who would not want to do this full time, like even just an index investing approach or a mutual fund investing approach might serve most of their purposes.
Yeah.
Right? Because they'll be able to beat inflation comfortably. they'd be able to make money over time and make compounding their friend. But of course, if you're interested, you could always get into direct stocks, as you mentioned,
Yeah.
trying out with a small pool of money and getting into this. And this approach makes complete sense. But on top of this, do you also recommend certain resources or courses that people could take? Like, do you think YouTube is something that people could just use to get started with these things? Do you think they should work with an expert? How do you think people could get started?
So I think right now there's enough on the internet for you to learn by yourself. Like you
Mhm.
don't necessarily need an expert at a very early stage.
Right.
In terms of resources, couple of resources I used when starting off was the Zerodha Varsity
Right.
modules. Those were insanely detailed,
Mhm.
and a lot of the fundamental and technical aspects, the basics get cleared out through those.
Right.
Apart from that, I'd say to understand the business side of things, a couple of things that I've started off late. I think Nikhil Kamat's podcast,
Mhm.
even Shark Tank, for that matter,
Right.
gives you a lot of context into how businesses and specific industries even function,
Right.
like what happens in the back end, apart from just the numbers you see on the internet.
Right.
So understanding that also gives you a lot more context. And once you have that sorted for the number part of it, couple of websites I use extensively are Screener and
Mhm.
Tickertape.
Right.
So that lets you compare companies within industries, see how they're performing related to their peers, the financials, all of that.
Right.
And apart from this, I think at an early stage, what I did was just downloading the annual reports of companies and just reading through them. It's a
Right.
massive document, but if you could read through at least the first few parts where the management speaks and then move to the financial statements, just going through how they progressed over the years, reading the footnotes, all of that also gives you a lot more context.
Right.
And yeah, once you build that, then I think you will find 2, 3 resources that you're most comfortable with. Like for me right now, it's Screener and Tickertape.
Right.
Like there are a lot of them apart from these as well.
That's
So
these are some great resources that you've sort of referred to, and in fact you told that you talked about that sort of Shark Tank example.
yeah.
That's a very good one because interestingly, like we do a lot of these personal finance sessions to
Mhm.
just teach people the basics of money. So how I actually explain to the audience what a stock is I tell them imagine yourself as a shark
Mm.
that's now choosing where they want to invest in.
Yeah,
So the way a shark analyzes a company is the valuation fine right now, right?
correct.
How are the business prospects, what are the modes
Mhm.
of the company. So you as an individual investor need to look at a stock just like a shark looks at as a startup,
Yeah,
right? So
for
this
sure.
perspective or way of thinking is something that becomes very relatable for people once they watch Shark Tank. So
Yeah,
that's a very good
100%.
point that you highlighted. I want to get to a problem point from whatever we've been talking about here.
Okay.
So there's a lot of resources online, right?
Mm-hmm.
There's courses, there are influencers who keep talking about money. But there can be one sort of a trap there, which
Yeah,
is how do you differentiate between what's good information and what's bad information? Because there's definitely a lot of misinformation out there as well,
for sure. Yeah.
right? So someone getting started, what are the sort of credibility nudges that you think they should be looking out for in order to validate that information?
Got it. So before I answer this, just want to mention one more resource, and you brought it up as well, which is just following the markets on a daily basis.
Right.
So be it watching news or once the market closes, you just
Mhm.
read through the report of what's happened during the day.
Right.
That gives you again a lot of idea as to what is happening in the markets in general, like
Right.
which industries are doing well, which stock specifically is doing well.
Mhm.
So just being aware makes a big difference, I feel.
Absolutely.
And again, having skin in the game kind of motivates you to follow markets on a daily basis.
True
So
that. No,
that's just one
and
resource.
one more thing that this reminded me of is so we are going to be starting this particular feature on our app very soon
Okay.
once it launches 3 months down the line,
Mhm.
which will basically summarize the key amounts of macroeconomic as well as the market data into insights that are relevant to a retail investor
Wow. Yeah.
who's a long-term investor, and we intend to do this as something that goes out daily whenever the markets are open, to sort of sort of bridge this gap between
Mhm.
what's happening out there and what is it in it for me,
Yeah.
more importantly, because I think that's where the gap happens. What's happening in the market, how does the Ukraine war affect my portfolio, things of that
Interesting.
nature,
Yeah. That'd be
right?
super helpful,
Right.
especially if it's contextual to the stocks I own.
Hmm.
If there was a quick short read that I could get after every market close,
Right.
insanely helpful, I'd say.
Got it.
Yeah.
No, good to know that. Good to know that. So let's talk a bit more about this. Like in terms
Yeah.
of these resources, right? Is there something
Mhm.
that you keep a lookout for to determine whether this is credible information?
Yeah. So for credibility, mostly if it's being reported by a lot of people, then that's one sense that okay, it could be something that is worth even looking into.
Right.
Apart from that, it's again super hard, I'd say, especially as retail investors, when there's so much opacity in terms of what's happening inside the company. Not much gets put out, especially in crisis situations, like we saw with the whole Adani fiasco that happened.
Yeah.
Like nothing much apart from just the report, Hindenburg report came out.
Yeah.
So from a retail POV, it's very hard, I'd say, to know what's right, what's wrong.
Right.
It's um, just being aware that what could go wrong and being prepared for it is the best we can do.
Right.
I feel.
So are you recently familiar with the whole thing that's been happening with the finfluencers and a SEBI regulation coming out about finfluencers? So what's recently happened is that SEBI came out there. And they basically talked about if anyone is providing any sort of financial advice online, then they can't do that unless they're licensed with SEBI. Right. So this was something very interesting for us because we are a SEBI registered investment advisor as a company. One simple way that people could use is look for entities that are licensed by SEBI.
Right.
Because that means SEBI has oversight into those business models, as well as SEBI is trying to ensure that they're working towards the best interest of the consumer. Right? So this could be one that you could take note of. Maybe there's a lot of influencers that you already follow and they have a SEBI certification, but you haven't noticed it.
Yeah.
Right? So this could be one interesting one that you could explore.
Interesting. For sure. Coming back to your question about separating the good from the bad information, like how do you know about it? I'd say if the information you're looking for is specific stock specific tips, then definitely don't trust anyone online.
Right.
But if the information you're looking for is more sectoral or just understanding concepts, things like that, then I think there's no harm in trusting someone because it's just the knowledge you're gaining. But if it comes to specific stock related information, I'd say like do thorough research by your own.
That's a very good point that you make. And I just want to add a small part to that. So stock tips are all over the internet. But let's say, forget about stock tips, right? Let's say you're working with an advisor and that advisor tells you certain stocks to analyze. Now, not every retail investor might have enough time to go into the depths of analyzing the company. But we call it something called quick research, where you could just do a high level checkpoint research into, okay, what are the valuations? Is there any red flag in the financials? What is the company's PR looking like from a business standpoint? Which you could do quickly to just get a intuition into whether this is sound advice or not. So I would say most people don't need to delve into the kind of depths that maybe you're delving into or maybe I'm delving into as an advisor. But they could just start forming an intuition to be able to validate good information from bad information. Right? And that could be some sort of a midway path between going it themselves as well as completely relying on someone else's. Okay, so let's we've spoken a lot about equity investing, stocks, mutual funds, even bonds for that matter. But when it comes to young folk, like folks right out of college, just like yourself, right? There have been all sorts of investment instruments that have been gaining popularity recently, right? For example, crypto, etc. For example. So what are your thoughts on those, and where do you think the general sort of trend is heading, and how do young people look at investing now?
Got it. Specific to crypto, like honestly, I don't have a lot of context. Like I've consciously stayed away from it.
Right.
Just because of, again, the opacity of information. Like you don't know what the use cases of crypto could be.
Right.
It's very speculative in terms of the time horizon that people are investing for. So, and of course, the volatility added to it. Like I just stayed away from it. So don't have much context there.
Right.
But in terms of how the younger generation is investing, I think one thing that I've seen even in the last 4 years is awareness about investing has improved drastically.
Right.
Like right now, I have 2 colleagues who are below the age of 20 and I've already started investing.
Oh, wow. That's great.
Which I don't think was a big chunk a few years back. So awareness has improved drastically. And one more thing, building on what we were talking about, like investing in products that you use or I think that's a trend that is again coming in because a lot of the younger folks I see who are invest in companies that they are aware of or they've used at least once at some point of their lives.
Right.
So that is one. But yeah, I think just the fact that people are getting to know about investing at a much earlier stage of their lives
Mhm.
is the biggest difference I see.
Right.
Right.
And that's a very good point. And I think you also talked about the concept of being familiar with what you're
Mhm.
investing in.
Yeah.
So we do agree with that approach completely, that you're better off with things that you know than
Yeah.
you're not. You're
Yeah.
more likely to make sort of more sensible calls there.
Good.
So I think that can be a good way that anyone starting off could sort of use that as a good measure for moving forward. But I want to sort of delve deeper into the crypto topic as well, right?
Mhm.
Because you mentioned that you're not completely comfortable with it. So from my perspective personally, my biggest lack of comfort there is that there's no way to determine a fair value. Like
Right.
with every
Yeah.
stock, with every other investment like a property or even gold, you can sort of determine the fair value of that particular asset. With
Yeah.
crypto, there's no way of doing that, and it ends up being completely speculative.
Yeah.
Right. So that's why it's completely an experiment, and if you're doing it, be prepared to potentially lose all your money, because we don't know how things are going to pan out.
For sure. Yeah.
So totally agree with that.
Yeah, and building on that, I think the one more difference with the younger investors is the risk appetite.
Right.
Like their risk appetites are way larger than even mine, where
True.
I'm still young. I consider myself to be young.
Right.
So that has also been a change. I think that's why even crypto has done so well, because a lot
Mhm.
of the younger crowd with their higher risk appetite are gravitating towards such investment
Right.
opportunities. So higher risk appetite is also one
No, that makes complete sense as well. And like I think one thing that does happen is once you understand how the markets work better, your risk profile tends to become more and more adventurous,
Yeah.
right? Because let's
Yeah.
say a person who doesn't have any idea about the markets, the moment there's a 10% dip, they start panicking.
Hmm.
Whereas if you know that it's going to recover eventually, as long as
Yeah.
it's a diversified portfolio,
For sure.
right? So
Yeah.
I think that has a huge role to play, and I'm glad that there's so much happening on the investor awareness and knowledge front. We are also trying to play a small role there, and hopefully
Yeah.
conversations like these will just help take things in the right direction on that front as well.
100%. Yeah.
Okay, so we talked about how young people are looking at investing, right? But let's talk also about how the previous generation looked at investing. So
Yeah.
primarily our parents, for example, right? I think asset classes like property, gold, or even fixed deposit were much more popular
Yeah.
at that
Yeah.
time. So what are your thoughts on that way of thinking?
I think again it boils down to the risk-taking appetite. Like
Mhm.
if you look at my parents or their generation, again, a lot of the portfolios for a long time were centered on real estate,
Right.
gold, and fixed deposits, as you
Mhm.
mentioned. But of late, even with my parents, I see that is changing. Like people are moving. My dad, for example, is moving more towards equity now.
Right.
And even across generations, that difference is very clearly visible. Like in my friend group, I don't know a single person who's invested in gold or even FDs for that matter.
Right.
And again, if you look at the next generation, they're moving to things like crypto. So it's a massive risk appetite increase that's happening across.
Right.
And I feel it's good. Real estate, I mean, no, nothing negative. Like in the 2000s, it performed excellently well. So
Yeah.
it made sense for it to be part of portfolio back then.
Mhm.
But I think as cycles change, right now, maybe investing in the stock markets is what is going to lead to exponential growth in the next few years,
Right.
at least in India.
Right. Absolutely.
So through the cycles, generations also, I think, keep adapting. Even gold, for example, did pretty well in the early 2000s and
Yeah.
till now. Even during COVID, sorry, gold has done pretty well.
Right.
So it's just the cycles and higher risk appetite that probably play a role.
Correct. No, that's a very good point, and I'll just add like a advisor's perspective to this. So we see gold very much as a hedge.
Yeah.
So when
sure.
stocks are not doing well, people keep looking for something that's more secure. So having a
Yeah.
small amount of gold in your portfolio helps with that hedging, and
Yeah.
property as well. As you rightly said, it's not something that we're against, right?
Yeah.
And in fact, now with mutual funds being able to give you exposure to property or even real estate investment trusts,
Yeah.
you could very well as add it to your portfolio to start off with.
Correct.
I think there's only one point which I would like to sort of pick on, which you talked about property being the first investment for our parents' generation. So although on the face of it, it seemed like a physical asset that's more secure,
Yeah.
but I would go on to say that it was actually a big risk that they were taking, right? Because imagine I've just started to work and I'm putting in most of my money into one single asset.
Yeah.
If that particular property diminishes in value, my entire portfolio diminishes in value, right? So you can't
Fair.
diversify, and also
Yeah.
you don't have too much liquidity. If you want to sell off your property, it might take months or even years to do that.
Yes.
Right?
Yeah.
So you can argue that it was a riskier
It was a
approach,
risk. back then. Yeah.
So I would say now, only when you've built up certain assets in liquid forms is when you should start thinking about property as an investment to or to even live in properties, right? So
Yeah.
I'll segue into to the next question with that, which is, what are your thoughts on buying versus renting in the current climate or environment?
I'd say at least for when you're young, right, below let's say 30, it doesn't make a lot of sense to buy because one, there's so much uncertainty into what the trajectory of your life can be in the future.
True,
Like today I'm living working in Bangalore, but maybe a few years later if I'm in a different city, it would make no sense for me to own property back in Bangalore.
true that.
So just that uncertainty, I feel to tackle that in the early stages of your life, it's a lot better to rent. But as you get older and you know where your base is going to be, you have, let's say, a family, it's more stable, then it maybe makes sense to buy even then,
Right.
because then it's more of, you're not thinking of it from an ROI monetarily. It's more of ROI as a family, as something, an asset that you own,
Yeah.
a lifestyle you're going to build around it.
Right. Absolutely.
So from those angles, it makes sense to buy later on. But
Mhm.
for now, definitely would say renting is a better way.
That's a really good point, and I want to sort of allude to something that's happening out there in the broad market, which is you see most influencers coming out and being completely against property investments,
Yeah.
right? So we don't want to go to that extreme because, as you rightly pointed out, in certain stages of life, when you need that stability, when you don't want to be continuously renting and moving places, right?
Yeah.
It does provide that stability to you, and if you sort of smartly choose the right property, you can have a decent capital appreciation there as well.
Yeah.
But I think the key point which you highlighted, which I totally agree with, is you need to make sure that you financially have enough of a buffer of liquid assets and
Mhm.
high growth assets before you delve into property. Right?
Yeah.
So that in terms of your down payment, it's not a very huge commitment for you. Or even in terms of your monthly EMIs, it's not something that's a very, very large chunk of your salary. Like ideally less than 30% of your salary.
Yeah.
So I think the way you're thinking about it, totally agree with that. And yeah, that's the right way to think about it. Okay, so I think again we let's again end off with talking about young retail investors who may be in college, who might be just out of college in their first job,
Yeah.
or even maybe someone who's 5-10 years into their career but just hasn't clicked that invest now button on any app.
Yeah.
What is that one advice that you would give to them today?
I think, as I mentioned before, just have some learning capital. Like having skin in the game is the best way to learn, because that's when you even care about the consequences of your decisions. If you don't have any skin in the game, then let's say you have like a mock portfolio you're trading on like a website, then you're not as worried about losing money there because it's not actual capital.
True that.
It's a great way to learn, but to actually make your decision making a lot more sharper and more confidence inducing, it's better to have skin in the game. So set aside a small capital initially to just learn, play around, try out whatever there is to try out, and once you start getting more confidence, start putting more and more capital into that.
Awesome, awesome. I think this was very invaluable advice, I would say, because I'll bring back that swimming pool thought again.
Yeah.
That when you sort of before you want to get good with swimming, you need to jump into the pool first,
Yeah.
right? And that small amount of capital is you jumping into the shallow end. You can't drown,
Yeah.
right?
You can't.
Once you get comfortable with the shallow end, you move towards the deep end, slowly but surely. But
Yeah.
but you learn as you slowly do that. And I want to leave everyone with this key takeaway today, guys. And thank you so much, Rohan, for
Thank you,
taking the time out and
Utkarsh.
speaking to us. Absolute pleasure. Continue what
Likewise.
you're doing. I think you're an inspiration to a lot of young people
Thank
who
you.
want to just get started with investing. I wish I did that when I was in college as well. And thank you everyone to our listeners. Hope you learned at least a couple of new things today. As long as you learn one or two new things every day, that's all you need to do. And come back for a podcast series. We keep talking to guests just like Rohan, and over time, hopefully, you'll become an investment pro with Cashvisory. Thank you so much. Have a great day.